In this video, we're going to be continuing the exercise that we started in the last video presentation. In that presentation, we had accounted for a $100,000 par value bond issue, and we accounted for the bonds through their entire lives. We ended the exercise by recording the final maturity of the bonds. Here in part 2 of the exercise, we're supposed to record the bond issue through the first year of its life, and then on January 1st, 20X2, record the retirement of the bonds. The corporation might want to retire the bond issue before its maturity date simply because it doesn't need the money anymore. More likely, the corporation is going to retire a bond issue early because interest rates in general have fallen. And by doing so, then the corporation is able to replace the old bond issue with a high interest rate with a new bond issue that carries a lower interest rate and achieve some savings in the process. Bonds are sometimes callable, and that refers to a provision that would be inserted into the bond indenture. The bond indenture is just the contract between the corporation and the bond holders. And if there's a call feature inserted into the bond indenture, then the call feature will specify prices that the corporation has to pay if it decides to call the bond issue in before maturity. If the bonds are called, then the bondholders are notified of the call, and they have to surrender their bonds to the corporation. The corporation then pays the call price that's specified in the bond indenture. Even if the bonds are not callable, the corporation can still go into the open market and buy in the bonds from existing bondholders and then retire them. Well, let's account for this bond redemption. In the previous video, we accounted for the bond issuance through the first year of its life by recording interest expense as the cash was paid out and by amortizing the discount on the bonds, recording it as additional interest expense. After the entry is made on December 31st, 20X1, the bonds had a carrying value of $98,000. And now, in part 2 of our exercise, we're to record the retirement of the bonds on January 1st, 20X2. Before we record this retirement, it's necessary to make sure that the balance in the discount account is current. Since we just made an entry yesterday to record interest expense and we amortized the discount at that time, then the balance presently in the discount account, $2,000, is current. In our exercise, the bonds were retired at a price of 101% of par value. So we pay cash out of $101,000 to the current bond holders. The $100,000 par value bond issue is then retired, and when it's canceled, we'll need to debit bonds payable to eliminate the balance in that liability account. On the balance sheet, bonds payable would now have a balance of 0. But remember, the discount account goes along with the bonds payable account. It's a contra account to bonds payable. So if we get rid of the balance in bonds payable, we'll also have to get rid of the balance in the discount account. This is a debit balance, so we'll need to credit the discount account in order to eliminate that balance. By debiting bonds payable and crediting the discount account, we've now taken a $98,000 liability off the balance sheet. So liabilities have fallen by $98,000, but cash fell by $101,000, the price paid to retire the bonds. We're left with a $3,000 debit difference in our entry. This debit will go to a loss account. Think of what we're doing this way. We've recorded a decrease in assets of $101,000. The liabilities on the balance sheet have fallen by the $98,000 carrying value that is now being taken off of the balance sheet. In order to make the entry balance, what we have to do is reduce owner equity by $3,000. There are only two things that reduce owner equity. One is a withdrawal and the other is expense. What we're doing is recording an expense of $3,000. But this is a special expense. We're going to call it a loss on the redemption of the bonds. Let's now account for the redemption of the bonds that were issued at a premium price. In the previous exercise, we accounted for the bonds when they were issued at a price of $104,000. We had a premium to record on these bonds, and we amortized the premium over the life of the bond issue. As of December 31st, 20X1, $2,000 of the original $4,000 had been amortized. That left us with a balance of $2,000 in the premium account. The premium account is added to the bond payable balance to determine the carrying value of the bonds on the balance sheet. If we now retire the bonds on January 1st, we'll need to debit bonds payable for the $100,000 and then credit cash for the $101,000 that we pay out. The premium account has a credit balance, so to close it out, we'll need to debit the premium account, and that then leaves us with a $1,000 credit difference in our entry. This credit difference will be recorded as a gain on the retirement of the bonds. If we analyze this transaction, then we can see that we're taking $102,000 of liabilities off the balance sheet. We're reducing cash by $101,000, and to make our entry balance, we need to increase stockholders' equity. Only two things increase stockholders' equity, and that would be contributions by the stockholders to the corporation or revenues. What we're doing then is recording a revenue, a $1,000 gain on the redemption of the bonds. So to summarize, when the bonds are retired, it's necessary to make sure that the premium account is current, and then we can record the retirement of the bonds by debiting bonds payable, debiting the premium account, crediting cash, and if there's a credit difference in our entry, recording a gain on the redemption. Remember, debit differences will be recorded as losses, and credit differences will be recorded as gains.